This is King World News. I'm Eric King, and you're about to hear the exclusive weekly GATA interview, this time with Chris Powell. Remember to go to our homepage at www.kingworldnews.com for more interviews this week with part 2 of John Malden's interview, as well as James Turk, chairman and founder of GoldMoney.com, and global head of currency strategy Mark Chandler, whose firm moves about $600 billion a month in the currency markets. Joining us now is Chris Powell, Board of Director and Treasurer for GATA. This was from a GATA dispatch today from Bloomberg. European central banks agreed to a third 5-year cap on gold sales and said planned disposals by the International Monetary Fund could be done within the accord. How important is this for the gold community, Chris?
I think it means that the European central banks are just about out of the gold business, Eric. They've very much reduced their gold sales in the last year. The agreement allowed them to sell up to 500 tons. The agreement expires September 26th, and they've sold only 140 tons this year. So the gold selling, the official gold selling is not coming out of Europe anymore. And with the new agreement, not only did they reduce the quota from 500 tons to 400 tons per year, they also said that the International Monetary Fund's plans to sell gold could be incorporated within that quota, which strongly suggests that the European Central Bank does not expect its member banks to come close to meeting the reduced quota over the next 5 years. So it certainly ought to be bullish for the gold market, at least insofar as the European banks are coming close to terminating their gold sales. Now, that doesn't mean that there won't be official selling elsewhere. Certainly there's a lot of suspicion that the United States has been selling gold or swapping gold or leasing gold surreptitiously, and I tend to believe that. There's a lot of evidence for it. But it does mean that Europe doesn't want to play the gold price suppression scheme anymore.
This was from the dispatch here. Central banks sold 73% less gold in the first half and full year. Disposals may drop to the lowest since 1994, according to estimates from London-based researcher GFMS. You were just talking about this, and you've been reporting, hasn't GATA for quite some time, that they expected the European central banks to really stop their selling altogether?
Yeah, it's been winding down, and there was a big story in the Financial Times back on the front page of the Financial Times back in May about how the Europeans were losing enthusiasm for selling gold. Gold sales are largely a mechanism for supporting the dollar, sometimes for supporting other currencies, but in recent years it's been largely a mechanism for supporting the dollar, and it has cost the European central banks an awful lot of gold. They've sold it at much lower prices, and they're looking fairly silly to their constituents, at least insofar as their constituents see an asset that has been lost at a lower price than the current price. Of course, their constituents don't understand that something else has been gained by the loss of the gold, and that is support for the dollar. But I'm not sure that Europeans would approve of the expenditure of so much of their national patrimonies to support some other country's currency.
This was an interesting comment. The Swiss National Bank, one of the signatories to the new accord, in a statement said today it isn't planning any gold sales in the near future, and that its gold is an important part of its monetary reserves. Switzerland has about 1,040 tons of gold, making it the 7th largest holder. What did you make of that comment, Chris?
Well, I think it means that Switzerland's gold sales are done, and they were probably undertaken largely to rescue Swiss banks like UBS, which were short large amounts of gold in a rising market and could not recover the gold without official sector help. We've always believed that the gold sales by the Swiss National Bank and the other European central banks were not so much fresh sales of real metal hitting the market as they were cash settlement of gold loans that the European central banks had made to their big national banks to short the gold market with. That is, no new gold or very little new gold was hitting the market with these gold sales in recent years. They were just writing off the short positions of the big European banks that had sold borrowed gold and could not recover it.
It says also the IMF has not signed, and this leaves open the possibility that the Chinese, Russians, and another central bank could buy the 403 tons of the IMF gold in one go. When you see that, I mean, they're talking about how much they would sell in a given year, but there's tremendous demand out there from other central banks for this gold, is there not, Chris?
Well, this would be a very painless and undisruptive way for dollar-heavy central banks like China's and Russia's to diversify their foreign exchange reserves without really disturbing the currency markets. I was at a dinner in New York a year ago, and unexpectedly it was attended by Robert Mundell, the Columbia University economics professor who is regarded as the inventor of the euro. Mundell is a consultant to the Chinese government, and I happened to be sitting next to him when he spoke to the assembly, and he volunteered that he had recommended already to the Chinese government, you got to remember this is a year ago, that if the International Monetary Fund should sell any gold, that the Chinese government should buy all of it. Now, this remark in the Bloomberg story today is not original. The idea that China or Russia or somebody else could snap up all that IMF gold in an instant has been going around for some time, and I doubt that any of the IMF gold will actually hit the markets generally any more than the European Central Bank gold has been hitting the markets in recent years. It's just been used to write off short positions.
Let's talk about China a little bit more for just a minute, if you don't mind, Chris, because they obviously had the purchase and increased the amount of gold that they had in their reserves. But I guess my problem with that is that they've been a pretty steady 1.4% for quite some time. Aren't the Chinese, and isn't their banking system totally underweight gold at 1.4%?
Well, we believe them to be. There's a lot of gold in private hands in China and countries like India, where private gold is really held as jewelry, but it's really considered monetary gold, a form of savings. China's always been had a very heavy, very strong gold tradition, which is really being encouraged by the government now since it's opened its gold market locally. China announced this year that it had obtained something like 400 tons of gold in recent years. So it has been acquiring gold surreptitiously. If they're admitting having obtained 400 tons in recent years, they probably have a good deal more than that, and they're probably inclined to obtain still more. But you're absolutely right. The huge disproportion in the Chinese foreign exchange reserves is being addressed. Chinese are looking out for their own interests. They're also looking to be responsible in international affairs. They would like to diversify without knocking over everybody's apple carts, or at least not knocking over the apple carts until they are indeed fully diversified.
In the past, though, we've seen central banks with 40% of their reserves in gold, have we not, Chris? So if the Chinese just wanted to go to 10%, I'm just saying, isn't that a tremendous disruption? And when I talked to John Hathaway about this, he just said, I don't think the gold can come from anywhere. You have to, they can accumulate gold and they can do that, but it's almost going to happen through a dramatic repricing of the price of gold to try to get these central banks to a greater equilibrium on what they need.
Yeah, this is an argument that people like Ted Butler have been making in regard to silver. It's much easier for small investors to get hold of gold and silver than it is for large investors and central banks, just because it is so rare and precious now. But I do think that if we're talking over a period of years, China can obtain as much gold as it wants without terribly disrupting the market. I think they can put a floor under the gold price. I think they probably already have done so, and it just may take them a while to balance their foreign exchange reserves. But we see them very active around the world, buying up natural resources and even building inventories of metal and oil. I think they are going to be very steady about this, and it's only going to be supportive for the gold price.
Well, thank you so much for joining us, Chris.
My pleasure, Eric.
Thank you for joining us at KingWorldNews.com. Remember to tune in next week for another great show where we will have Peter Barnes, CEO of Silver Wheaton, Bill Fleckenstein of Fleckenstein Capital, and much more. Also remember to go to our Gold Plus page for exclusive weekly interviews with Ted Butler and GATA.